Hello everyone, my name is Jacob Merk and I'm the Vice President of Investment Strategy here at Provident Financial Consultants located here in Oshkosh, Wisconsin. And today we're going to talk about that all-important credit score and what components make up that score. And then we'll talk about different factors that can negatively and positively impact your credit score. So let's just jump right into the material.
Building and maintaining your credit score plays a vital role in your financial plan. If you can receive a lower interest rate, you could potentially save hundreds, if not thousands of dollars over the span and term of your loan. In some cases, your credit score can also determine if you can even receive that loan. So it plays a big factor into your financial plan. So during today's conversation and during our presentation today, one of the first steps in building a financial literacy is learning the ins and outs of your credit score. On the page is a roadmap of what we're going to be talking about today. Because your credit score reflects the information in your credit report, let's start with the main credit bureaus and what is inside of this important credit report. When we look at the three main credit bureaus that gather data and create reports, the three main ones are Equifax, TransUnion, and Experian. These three credit bureaus gather data about you from lenders on the type of accounts you have. So this could be your credit card, auto loans, mortgages, the date that you open that account, your credit limit or the amount of the balance and your payment history, including whether or not you've made your payments on time. They then create a credit report which contains 4 sections: your personal information, your credit and payment history, public records, which would include your bankruptcies, judgments, tax liens, and collections, and then finally the entities that have required your credit report. Credit bureaus can provide these reports to the following people: lenders you are seeking credit from, lenders that have already granted you a loan, utility companies, telephone, cell phone companies that provide services to you, your current employer, or if you're applying for jobs, prospective employers, but you have to agree to this and you usually sign a form that gives permission to your employer or your prospective employer to do that. Insurance companies that have issued or may issue a policy to you. So this would also include your homeowner's insurance, your car insurance, companies that are providing a service to you and are insuring some of the things that you own. Government agencies reviewing your financial status for government benefits. And finally, businesses with a legitimate need, such as a landlord or a bank. Your score is largely based on the information that is in your credit report that we just talked about on the previous slide. So again, what's your payment history? How much do you owe? How long have you had a credit card, or how long have you had a loan balance? What types of credit that you have out there? And finally, what we didn't get on the last slide, but what also goes into your credit score are your inquiries. A hard inquiry are generally when a financial company checks your credit when making a lending decision. You typically have to give them authorization in writing that says that they can take a look at your credit report in order to acquire a loan. So again, this is something that you have to give permission for, where a soft inquiry is when a person or a company checks your credit to see if you qualify for a promotional offer or as part of a background check. In this inquiry, in the soft inquiry, your permission is not needed as a soft pull and does not impact your credit score because you're not giving permission to look into your credit report. So if you're anything like me, I get sometimes those promotional offers from the credit card companies saying that I qualify for this introductory interest rate and I qualify for a certain credit limit. They have pulled a soft inquiry on my credit report to see if I would fall underneath this promotional offer that they want to offer people. So again, there's a difference between the hard inquiries and the soft inquiries, and with the hard inquiries, that can impact your credit report and your credit score. There are a number of credit scoring models. However, FICO score is used by 90% of the top lenders. The Fair Isaac Corporation introduced its FICO score in 1989, and they did this to help standardize credit scoring while also removing bias from lending, which is also important. These scores are from FICO's basic model. This helps lenders to make more informed decisions. FICO also tailors their models to industry-specific products. The credit bureaus also use FICO scores as a part of their model. So there are a lot of different scores out there. Your score is also constantly changing as new data is added. So just because your credit score is maybe 750 today, depending on if you've been making your payments on time, have you acquired more debt, your score can change. And when we take a look at the slide that in this presentation that we're looking at today, there's 5 different categories. From if you're in the 300s to mid 500s, your credit rating is very poor, to if you're above 740, you're in the top 2 tiers of very good and exceptional credit score. So of course you want to be closer to the 700s and the 800s as you possibly can, because that will typically have you qualify for the best interest rates, and you'll have an easier time applying for loans. How do they come up with this FICO score? The first one we'll talk about, and it's the biggest portion at 35%, is your payment history. While paying off a student loan ahead may seem like a good idea, you should also consider the missed opportunity that you can show that you could pay off that 10-year loan. You may be saving interest over the long term, but if you're a new person and if we're looking at a student loan and you don't have a very long credit history, it may be advantageous to you to continue to pay the student loan over the 10-year time to help improve your FICO score. The second one is the amount owed. This is about 30%. While you might get a great offer on consolidating a credit card balance, this could help bring your credit utilization rate above 30%. And we'll talk about this quite a bit throughout today's presentation. But to give you a better understanding of what this utilization rate and that 30%, let's give you a new example. So let's just say you have 2 credit cards. Each credit card has a $1,000 balance, and you have a $5,000 credit limit on each one. So you have a $2,000 credit card balance altogether. And let's just say, as I mentioned earlier, you got a promotional offer from the credit card company on one of the 2 cards that says if you transfer the balance, we'll not charge you interest, or it'll be a very low interest over the next 6 months. So you take advantage of this, you close one of your credit cards, and you move the balance to the one main one that you want to continue to use. So now your balance is $2,000 and you have a $5,000 credit limit. Your utilization rate has now gone over 30%, where your utilization rate's at 40% because you're having a $2,000 balance and your credit limit is $5,000. Where if you just kept the 2 credit cards available that you were using, you were at 20% because you had a $1,000 balance while having a $5,000 credit limit. So just keep this in mind if you're thinking about making some transfers and transferring balances from one credit card company to another. The third one that we'll be talking about today is the length of your credit history, and that makes up 15% of your FICO score. So again, don't close a credit card account just because you're not using it for a period of time, or you're not using as much as other cards, especially if you've had that credit card for the longest period of time. Just stop using it until you can build up a longer credit history on your other cards, and then it might be a better idea to close your credit card at that time. The fourth one is new credit. So again, as we talked about, hard inquiries can affect your credit score. So if you want to buy a new car as well as new furniture or something else in a short period of time, a lot of consumer organizations suggest that you should plan ahead and space your request for credit over at least a 6 to 12 month period of time. Also, if you're shopping different rates, so if you're having an auto loan and you're looking at different credit unions and banks, try to do this within a short period of time, within 45 days. So if you're looking at one credit union and then one of the big banks and you're trying to compete for a rate, if you do it within that 45 days, it's only considered one hard inquiry. So again, just try to time out some of your big purchases that you may need a loan for over longer periods of time. while also keeping your shopping around for rates, trying to receive the lowest interest rate that you possibly can within a 45-day span. And then lastly is your credit mix at 10%. If you have different types of loans out there, like having a credit card, student loans, auto loans, that they're all not just auto loans or they're not just all credit cards, it can show that you can manage and handle different debt and pay according to the terms that you've agreed to with the lending institution. Your credit score is one of the most vital parts of your financial life, and it follows you forever. Your score determines if you'll be approved for a loan or not, the amount you may qualify for, the interest rate you'll pay, and the credit terms. People with higher scores generally get the best deals. And if we go back to the previous few slides ago, if you have in the 740 to 800 range, you'll qualify for better loans than someone who would maybe be in the credit score of 5 to 600 range. So again, it's important to have a better FICO score there. And as I'm going through this, many people think that credit score only really matters when it comes to being approved for a loan or a credit card, but it goes far beyond that. Utility providers can check your score and charge higher fees or rates if you have a lower score. Also, many employers will use credit reports to screen prospects. Landlords want to know how likely you are to pay your rent. And finally, it can affect your relationships. I know that seems a little funny, but again, according to a study that was done by Finder, more than 1/3 or 38% of adults would reconsider a romantic relationship because of the other person's debt. Let's talk about how your credit score can be negatively impacted. And the first one we're going to talk about today is a mispayment, and that seems obvious. If you're delinquent on your loan or haven't made your payments on time, that can remain on your credit report for up to 7 years. So if you're going to miss a payment, at least make sure that you make it within your grace period if your loan offers one, to try to keep that off of your credit report. Don't max out your credit cards. Keep your balance below, again, that important 30% utilization rate on your credit limit. Don't try to apply for too many loans or credit cards in a short period of time. Try to space those big purchases out over a few years if you can. If you cancel your credit cards with zero balances, that also will have a negative impact on your credit score for a short period of time. Also reconsider that if that's the credit card that you have the longest payment history on, which it could even impact you even further. Also, if you're going to transfer balances to a single card, remember that 30% utilization rate in the example that we talked about earlier. Try to keep those balances underneath that credit limit, because that will keep your score at a higher limit. Otherwise, if you need to go to it above that 30%, try to keep that period of time as short as possible. If you're co-signing for a loan, this happens quite a bit with grandparents and parents when they're trying to help out their grandchildren and children. Know that you're adding your grandchild or child's credit history to your credit report. Another one is to check your credit reports regularly, and if you find an error, fix it right away. Because if you let that go undisputed, that can impact your credit score, and that's on your credit report, and that will bring your credit score down, and that could potentially be the difference of receiving a better rate, better interest rate on the next loan that you may apply for. And lastly, this is the most obvious out of all of them, but it's important to keep in mind: avoid debt settlements, foreclosures, and everything along those lines. Most public records remain on your credit report for 7 years, and some bankruptcies may remain on your credit history for up to 10 years. So again, that's going to be on your record for a long period of time, and we want to try to avoid those if we possibly can. We were just focusing on the negative ways that your FICO score can be impacted, but let's take a more positive approach to things and what things we can do to improve your credit score. And the first one is, again, just make your payments on time. A late payment can be a 100-point hit to your credit score. So please make your payments on their due dates to make sure that that doesn't happen. Second one is, again, keep tabs of that 30% credit utilization rate. If you're finding that your balance is close to it or above that, quite frequently, just see if the credit card company could increase your credit limit so your balance is underneath that 30%. It doesn't hurt to ask and see if they can do that. Try to time your applications carefully. Hard inquiries can be on your credit report for up to 2 years. So if you can try to time your bigger purchases over a few years or at least over a year period of time, that's going to help your FICO score. Only apply for credit cards as needed. I know it's tempting sometimes when you go purchase or when you go to make a purchase at a store and they say, if you open a credit card with us, you'll get a 20% savings on your purchase today. If you do this at all the stores that you go shopping at, you could have a lot of credit cards in a very short period of time. And then it's hard to keep track of where the balance is, what payments you need to make on time. So if you're going to apply for a credit card at a store, only do them at the places that you do a lot of shopping at and just keep it at that. Pay off the debt and don't move it around. As I mentioned earlier, they have those promotional offers for a low interest rate or zero interest rate for a period of time. It may help you for a very short period of time, but it could negatively impact your score. So just pay off the debt based on the terms you'd agreed upon with that lender. And lastly, fix your credit report errors if you find them. Again, why there's an error is usually a negative impact on your score. So if you can fix that, that's going to be an immediate boost to your score. It's great now that we've figured out how we can improve your FICO score. But how can we check what your score actually is? And many people think it's actually on your credit reports when you go to the websites, but that is not the case. If you may see something on there when you go into Experian or TransUnion where it says look into your FICO score, it's going to take you to another source that's not provided by them. So again, it's not on your credit reports. If you actually log in, it's not going to have your FICO score at the top of the report. So how can we check what this score is? Many credit card companies and loan companies provide credit scores for their customers. It may be on your statement or you may be able to access online. For example, with my credit card company, I can access my credit score online through a different portal where I can check out what my FICO score actually is. Some banks also may be able to provide your score as a part of their service. You may also even pay for a credit score service that monitors your credit. They sometimes offer you a free trial service for a period of time, and then you are charged a monthly or annual fee after that. If none of those sound attractive to you or they're not offered with some of the institutions that you're working with, you can also buy your score directly from FICO or the other credit card services. If you purchase your score, you are not required to buy a monitoring service. So again, depending on how it fits within your lifestyle and how this is going to work for you, there's many different ways that you can check out what your FICO score is. Let's talk about some actionable things we can do to help improve that FICO score. Check your credit reports, and it doesn't matter if you're 18 or age 85. If there are errors on your credit report, it can impact you more than just financially. So again, it's important to make sure that any errors that are on your reports are taken off. Be careful of suggestions. I know there's a lot of suggestions that are out there on television or on an article over the internet. Know exactly what hurts and what can help your credit score. You may see a suggestion online that says this improves your credit score, and in all reality, it could negatively impact it. So again, just be very careful about that. Don't ignore the signs of something that has gone wrong. Small charges on your credit card, things that you don't remember, unrecognized loans on your credit report are all things that can negatively impact your FICO score and can have you spending more money than what you actually owe. Put together a budget so you know how much you spend and where your money goes. Especially if you utilize credit cards, it's very easy to rack up charges and you are spending more money than what you actually think you're spending. So it's important to put together a budget so you make sure that you're making more income and bringing more income in than you're actually spending. That's going to help you for a lot of financial success in the future if you can do that. And lastly, if you're with someone, whether it's a partner or spouse, it's important for communication like almost every other aspect of life. Especially if you co-sign for a loan or you commingle your money with a joint bank account, joint credit cards, it's important that you know what each other are spending, so you are making sure that you're not overspending and you're putting yourself in financial harm.
Thank you for joining me for today's webinar. I hope you learned quite a bit about your credit score and what components lead into that score and ways that you can improve it over time. If you have any questions about financial planning and trying to get to your financial goals, you can reach us at any time at info@providentfc.com and someone will get to you shortly. Again, thank you for joining me today, and we can't wait to see you during our next month's webinar.